Today, we're going to look at building an investment portfolio, and we're going to approach it exactly like constructing a sturdy, long-lasting house. You don't just, throw up some walls and cross your fingers that the roof holds, right? You need a solid foundation, you need the right raw materials, a really well-thought-out blueprint, and, of course, a realistic plan for long-term maintenance. So let's dive right in and look at the architecture of a genuinely sound financial structure. But before we even pour the concrete, we've got to clear this site of a super common, really stubborn myth. You hear this all the time. People saying that Wall Street is literally nothing more than a chaotic casino, that putting your hard-earned money into the market is basically just rolling the dice. So is investing really just gambling with extra steps? Look, it's a completely fair question, especially when you're watching stock prices wildly jump around on the evening news. But here's the absolute critical difference, and this is beautifully summarized by insights from Charles Stanley. In gambling, there's a built-in mathematical expectation of a negative outcome. Sure, you might win early on, but the longer you sit at that blackjack table, the higher the mathematical certainty that you're going to lose money. The house always wins. Investing? It's the exact reverse. Now, you can totally lose money over short time frames, absolutely. But over the long haul, investing historically expects a positive outcome. The longer you stay invested in a diversified way, the higher your likelihood of actually making your money grow. It's about participating in global economic growth, not, just spinning a roulette wheel and hoping for the best. So here's our quick roadmap for today's explainer. We're going to start by demystifying the stock market. Then we'll open up your investment toolbox. After that, we'll draw up your asset allocation blueprint, explore how you can invest with your personal values, and finally, wrap up with how to avoid some of the most common structural mistakes. All right, phase 1, demystifying the stock market. Let's get into it. What's truly fascinating here is the concept of the secondary market. When everyday investors buy a stock, let's say a share of a massive tech company, they usually think they're handing their money directly over to that company. But as data from Chase explains, that only actually happens in the primary market, like during an initial public offering or IPO. What you and I are almost certainly participating in is the secondary market. You're fundamentally just connecting with another investor out there who wants to sell their shares, and you two are agreeing on a price to make the trade. The company itself, it doesn't make a single new dime off that specific transaction. It's really just a massive ecosystem of buyers and sellers trading existing pieces of the pie. Moving right along to phase 2, your investment toolbox. Now, you could go out and buy individual stocks. That's kind of like buying a single brick for your house, one at a time. But a highly efficient tool we have in our modern toolbox is the Exchange Traded Fund, or ETF. Think of an ETF as a massive, pre-packaged palette of various building materials. It basically pools money from a bunch of different investors to buy a widely diversified basket of securities, literally hundreds of different stocks or bonds all at once. And the best part? It trades on an exchange throughout the day, exactly like a regular individual stock. It's an incredibly accessible, low-barrier way to grab instant diversification without having to agonize over picking dozens of individual companies yourself. And keep in mind, those materials come in a few different forms. We've got data combining insights from Pitcher Partners and Thrivent, and it brilliantly lays out the fundamental risk-return spectrum of our asset classes. Right at the top, cash. It's your lowest risk, obviously, but it also offers the lowest long-term growth. Moving down a step, we have fixed interest or bonds, which are basically just loans you make to a government or a corporation. These offer low to medium risk with steady conservative returns. Next, we step up to property and real estate, bringing us into medium to high-risk territory. And finally, down at the bottom, shares or equities. Buying actual ownership in companies gives you the highest potential for long-term growth, absolutely, but it comes with the highest volatility and risk. A sturdy house needs a strategic mix of these different materials to really stand the test of time. Which leads us perfectly into phase 3, the asset allocation blueprint. Asset allocation is literally the mathematical magic behind your portfolio. It is simply the exact percentage of your money that you assign to those different asset classes we just talked about. A classic, very traditional blueprint is the 60-40 split. That means 60% of your money is in stocks for growth and 40% is in bonds for stability. And get this, academic studies, like the famous ones detailed in our Wikipedia source, show that asset allocation actually explains more than 90% of the volatility of your overall portfolio's returns. So it's not at all about trying to perfectly time the market. It's really about the overarching structural balance between risk and reward, tailored entirely to your personal timeline. And historical data brilliantly proves why getting that blueprint right matters so much, especially when the economic weather turns ugly. Just look back at the severe 2000 to 2002 bear market. An aggressive portfolio holding 80% stocks that suffered a brutal 34% loss after inflation. Ouch. A more balanced 50-50 portfolio dropped by about 14%. But check out the conservative allocation. A portfolio with only 20% stocks and 80% bonds actually gained over 6% during that exact same massive market crash. It's wild, right? This just perfectly proves how a more conservative asset allocation acts as a critical shock absorber against severe financial storms.
All right, phase 4, investing with your values.
You're going to hear the acronym ESG thrown around a lot in modern investing. Based on insights from the IMD Business School, here is exactly how investors use these metrics to screen companies. E stands for environmental, so assessing a company's carbon footprint and its overall impact on the planet. S is social, looking closely at their labor practices, human rights, and even how they treat their supply chain. And G is governance, evaluating things like corporate transparency, diversity on the leadership board, and whether executive pay is actually fair. Investors use these specific neutral metrics to try and ensure the companies they fund reflect the kind of world they actually want to build. However, you really got to be careful when you're shopping for these custom upgrades. You need to absolutely watch out for greenwashing. This happens when companies use clever, slick marketing to falsely portray themselves as super environmentally friendly or highly ethical, basically just to attract conscious investors without actually doing any of the hard work behind the scenes. To dodge these fake ethical credentials, it's vital to look way past the glossy marketing brochures and rely on reputable third-party ESG ratings and rigorous data.
And finally, phase 5, avoiding common mistakes.
According to Charles Stanley, there are 3 major traps that investors constantly fall into. First up, taking the wrong amount of risk. That means either gambling way too aggressively or, on the flip side, being so conservative that inflation just quietly eats away your savings. Second, reaching blindly for yield. Listen, if a bond or a stock is offering an unusually high payout, I'm telling you, that is almost always a glaring red flag signaling high underlying danger or massive debt. And the third trap? Panicking over unexpected negative news events and selling your assets at the absolute worst possible time. The really crucial point here is captured perfectly in a football analogy from Charles Stanley. Successful investing is not about attempting a spectacular wonder goal from the halfway line just to impress your friends. It's actually far better to be generally correct through steady diversification and risk control than it is to make a huge, high-risk bet, be absolutely wrong, and suffer permanent capital loss. It's about defense just as much as offense. And this brings us to a really fascinating field highlighted by Itaro called behavioral finance. You see, you can have the most perfectly designed asset allocation blueprint in the entire world, filled with the absolute best low-cost ETFs. But this field of study shows us that none of that math matters one bit if human emotion takes over the steering wheel. Our brains are literally hardwired to feel the pain of a financial loss much, much more acutely than we feel the joy of a gain. So when the market inevitably drops, and it will, panic and emotional bias can easily cause investors to just completely abandon their carefully laid plans. Which leaves us with a final, kind of provocative thought to end our explainer today. What truly is your biggest investment risk? Is it the mathematical volatility of the global stock market, or is it your own mindset? Remember, a sturdy house can absolutely withstand a hurricane, but only if the owner doesn't suddenly decide to tear it down during the middle of the storm. Thank you so much for joining me today, and I really hope this architectural guide has empowered you to take confident, structured control of your financial future.